Is the U.S. economy set up for a soft landing? How will the new advances in artificial intelligence ripple through the investment landscape? Hello and welcome to this Cedar River Capital Market Touchstones slideshow update for the third quarter of 2023. The date today is September 10th, 2023, and today we'll be discussing these and other factors driving the stock and bond markets. My name is Paul Latta. As in prior slideshows, I'll be doing the speaking today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. Our agenda today will be familiar to viewers, beginning with a discussion about the recent market action. We'll then look at the economy as a backdrop to put more context into the market discussion. Then we'll move into a microeconomic view and look at the key industry-specific drivers. And then we'll conclude with the longer-term observations about the investment landscape. The S&P 500 has done quite well over the last 5 years, as you can see here. Good news is that the S&P is up 68% in the prior 5 years. Last year, of course, was a down year, being down about 18%, but the S&P is up about 17% this year so far, and we are again encroaching on new highs. The bond market has been challenged in the last couple of years, mainly due to the Federal Reserve's rate hiking campaign. Short-term and long-term bonds are both seeing higher rates compared to prior years. The chart on the left is the short-term 2-year treasuries, which have been tracking overnight Fed funds fairly closely. And they've lifted from near zero just after COVID to the present level of 4.97%. The chart on the right is for long-term bonds, 10-year treasuries. Long-term rates are also higher, though not quite as tightly correlated with Fed rates. Indeed, the upward trajectory of long-term rates lagged the move on short-term rates. The yield on the 10-year treasury is only 4.27%, well below the 4.97% of the 2-year treasury. This yield inversion has been with us for about a year now. The rapid rise in short-term rates and a slower rise in long-term rates has resulted in a sizable yield curve inversion, with short-term rates higher than long-term rates. At present, the spread between the short-term 2-year treasury and the long-term 10-year treasury is negative 70 basis points, as noted at the top right of this slide. The chart here shows how this spread has varied over the last 30 years. As you can see, the spread in the last year dropped as low as negative 100 basis points, and that was a 30-plus year low. We've had yield curve inversions before, in 2000, 2006, and a very brief inversion in 2019. All three yield curve inversions preceded recessions by about a year. This is why the street is fixated on the length and depth of today's yield curve inversion. However, the U.S. economy continues to hum along, as we will discuss in subsequent slides. And notably, the size of the inversion has seen some improvement in recent weeks, going from minus 106 in July to about minus 70 today, and the Fed seems increasingly reluctant to raise rates going forward. Speaking of the Fed raising rates, the Fed last raised rates by 25 basis points at its meeting back on July 26th. Fed funds are now in a range of 525 to 550 basis points, but recent commentary suggests that we are not likely to get another rate increase this year. The Fed is done. It's not yet cutting rates, but it's likely done raising rates. This table is from the Chicago Mercantile Exchange and looks at the implied probability of additional rate increases based on Fed funds futures, an excellent arm's length way to derive consensus probabilities. Based on the futures activity, the consensus is that the Fed is done raising rates. If you track the blue squares lower for subsequent meeting dates, it appears the most likely scenario is that the Fed will hold rates steady through April of next year. Then it will cut rates by 25 basis points at the May 2024 meeting. Further cuts are expected later in 2024. It might be worth noting that if the Fed does not hold steady through the balance of the year, it is more likely that the Fed will raise rates than lower rates, as you can see by the probabilities in subsequent meetings. Most other central banks around the world are also raising rates. After all, COVID was a global pandemic, and most central banks around the world are wrestling with inflation due to recovering demand and constrained supply chains. Also, central banks are motivated to coordinate and avoid currency movements arising from interest rate disparities. A handful of banks have gone off script and are not raising rates. People's Bank of China, due to the recent reversal of the COVID zero policy and the related inventory destocking. Also, Bank of Japan, mainly due to its history of deflation. In Latin America, Brazil and Chile are beginning to reverse their earlier hawkish policies, and indeed, Latin America's central banks appear to be leading the Fed by about 3 to 6 months. In contrast, the European Central Bank appears to be lagging the Fed, and more hikes are likely in Europe. Let's shift the topic back to the stock market. There are a handful of headwinds and tailwinds within the stock market as shown here. Top on the list is the Fed and, of course, other central banks. Certainly the idea of no more rate hikes is being greeted enthusiastically by stock market bulls. But bears will point out that the Fed's mantra of higher for longer. Today's high rates are not headed down anytime soon. Bulls will also highlight that the stock market valuation is clearly within norms over the last 10 years. Bears, however, they would not disagree with that, but they would point out that valuations are very high relative to the high rates that can be earned on bonds and even money market assets. We'll chat about this more in subsequent slides. Bulls will also highlight that money market deposits are at all-time highs and that money on the sidelines like that will eventually need to be put to work back in the stock market. Bears, however, would point out that money on the sidelines may not head to the stock market since excess personal savings during quantitative easing has now been fully depleted. We'll also chat more about money markets and personal savings in subsequent slides. Lastly, bulls will highlight the unexpected positive surprises in the stock market related to ingenuity, innovation, and invention. But bears will highlight the unexpected negative surprises, war, politics, acts of God. This chart shows the last 10 years of the S&P 500 in blue and the PE ratio of the S&P 500 in purple. As you can see, the S&P gained 225% over the last 10 years, a big number. In purple, you can see the price to earnings ratio has actually ranged from about 14 times up to about 23 times over the last 10 years, and the present rate of about 18.7 times, which is pretty near the middle of the historic range. This has been one of our favorite slides in the last few years. It compares the earnings yield on the S&P 500 to the yield on the benchmark 10-year Treasury bond. In essence, whichever line is higher is effectively the better value using this approach. As you can see, stocks remain the better value, but the higher rate environment has narrowed the lead considerably. We have reversed our aversion to the bond market in recent months and have started building bond ladders mainly using bullet bond ETFs, which we regard as a simple and elegant approach to getting fixed income exposure. Money market deposits continue to lift, now at nearly $6 trillion. Stock market bulls view this as a money on the sidelines and future buying power for the stock market. Certainly the Fed lifting rates ever higher has been a big draw to money markets. Most money markets are yielding over 5% now. But if the Fed eventually starts cutting, then yes, there is now nearly $6 trillion in potential future buying power for the stock market. By comparison, the market value of the S&P 500 is about $37 trillion right now, so $6 trillion of extra buying power will move the needle. This chart was published by the San Francisco Fed about 2 weeks ago and made high-profile headlines straight away since it implies a recession is imminent. As you can see, the chart shows that nearly all excess personal savings accumulated amid the Fed's dovish days of COVID have been drawn down during the Fed's hawkish days post-COVID. This may explain the seeming imperviousness of the U.S. economy to Fed rate increases over the last 18 months, and it seems to sound an alarm to complacent economists who are getting accustomed to the soft landing mantra. One of the most asked questions we get is about the persistence of the rally in large technology stocks in the first few months of the year. Will it continue? As you can see in the bottom half of the slide, the communications, technology, and consumer cyclical sectors dominate the performance of the stock market so far. And all three of these sectors are dominated by the high-profile mega caps: Amazon, Apple, Google, Microsoft, Meta, Nvidia, and Tesla. But in the last 3 months, at the top of the slide, the best performing sector has been energy. In other words, there has been some broadening of the market in recent months, a healthy development. Utilities remain in the basement on both charts here, partly on higher interest rates and partly on wildfires that may be related to the electric grid. Returns by style factor in the third quarter show a narrower than usual spread between the best performing style and the worst performing style. Perhaps this is another sign of a broadening market. We were pleasantly surprised to see the quality style factor bump its way to the top of the list for the first time in this 10-year history of the chart. A handful of our industry colleagues that run quality strategies seem to use this distinction to their marketing advantage. That is, quality is never the top performing style factor on a quarterly or annual basis, but is persistently at the top of the list when measured in 5-year increments or even 10-year increments. There is merit to this claim, and the fact that quality bumped to the top so far in Q3 is likely more reflective of the narrow spread between best and worst rather than quality suddenly seeing short-term appeal. The U.S. market has been doing a little bit better than the rest of the world so far this year, up about 17.45%. Perhaps this is another sign of reversion to the mean given that the US modestly underperformed the rest of the world last year. Such reversion was likely driven by the action in the mega cap tech names which underperformed last year and outperformed this year so far. Interesting to see that the best performing geographies were all beneficiaries of reshoring away from China: Vietnam, Mexico, Japan, Korea, India. China itself seems to be experiencing investment outflows mainly on geopolitical tension over Taiwan and trade-related issues. Europe markets are near the top of the list so far this year, mainly a reversion or bounce from a deeply oversold 2022. This has been partly offset by the ongoing rate increases at the European Central Bank, which is lagging the US Fed by several months. Overall, despite a few pockets of weakness, global market performance is actually doing reasonably well. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin by looking at GDP levels by country. This chart shows the International Monetary Fund's present economic forecast by country for 2023 and 2024. As you can see, some regions have tailwinds and others have headwinds. Regions with tailwinds appear to be under a uniform theme of benefiting from reshoring away from China. This again includes Japan, Mexico, India, and a couple of others not shown, Korea and Vietnam. China growth has been quite soft recently, likely due to post-COVID destocking, leverage issues, and geopolitical tensions. Most countries in Europe are shown here with growth close to zero for 2023 and not much better for 2024. There are a handful of headwinds in Europe, proximity to the Ukraine being right at the top of the list, but the German auto sector seeing structural changes in electric vehicles as well as its China relationships, changes in energy infrastructure, and of course the European Central Bank being late to the hawkish game. At a broad level, inflation lifted higher in 2021 and early 2022 and has been softening in late 2022 to the present. Most non-China regions are seeing inflation in the 3% to 6% range, which is well below the peaks seen in the summer of 2022. Europe is a touch worse than the US, likely reflecting the lag of the European Central Bank, which went hawkish about 5 months behind the US Fed. China headline CPI dropped below zero last month, raising concerns about a Japan-like deflationary trap. However, core CPI, excluding the volatile food and energy, was actually above zero, and excess inventory is just starting to clear. There are many ways to measure inflation: consumer price index, CPI, producer price index, PPI, personal consumption expenditures, PCE, and you can look at any of those three on the headline numbers or just looking at the core numbers that exclude the volatile food and energy. This chart shows all six, but conclusions are essentially the same. Inflation is down significantly from its June 2022 peak. Headline CPI was at 3.2% in July, a big improvement from over 9% last year, but still ahead of the Fed target of 2%. Recent data has shown a small uptick, which is not unexpected as we close in on the target 2%, though might be concerning if upticks do persist. Shelter costs are the main driver of the most recent uptick, and there has been some concern that recent increases in spot energy prices may work their way through to higher future headline CPI inflation. Still, the trend over the last year has been lower inflation. Wage inflation is also tapering, with August figures showing a 4.3% increase. That's down from nearly 6% in early 2022. In the last year, most of the wage inflation was in the COVID hit areas, such as nursing, education, retail, and leisure and hospitality. But in more recent months, only leisure and hospitality is still problematic. Other industries like mining and wholesale are elbowing out the COVID hit industries. Wage inflation is a key measure of inflation since wage inflation is an irreversible form of inflation. That is, wages can go up or they can be flat, but they never go down or deflate. Notably, the recent monthly employment reports have been strong, though somewhat below peak levels earlier this year. Payrolls are still positive. The temporary help index, the only labor market leading indicator, has softened but remains well above recession levels. Bloomberg keeps track of the consensus probability of a recession in the next 12 months. This chart shows the dispersion of estimates among the 56 economists in the survey. Quite the range, with optimists near 0% probability of recession and pessimists near 100% probability of recession. The consensus at present is a 60% probability of a recession in the next 12 months. That may sound a little intimidating given that a recession occurs on average once in every 7 years. That is, there's a 14% chance that any given year might be a recession year. Yet at the same time, The survey of economists has seen virtually no change in the last 12 months. It's been a 60% chance of recession since August of 2022. Optimists are inclined to cite the Fed's successful history of soft landings, the strength in the labor market, consumer confidence, and the very fact that the pessimists have been wrong for 12 straight months. Pessimists, in contrast, are likely to cite the present high interest rates, which are likely to remain, quote, higher for longer, the inverted yield curve, economic challenges in Europe, and the fact that excess personal savings have now been exhausted. This is our last slide on the macro situation. Geopolitical risk remains elevated, mainly due to the situations in Ukraine and Taiwan. This chart is the Geopolitical Risk Index over the last 40 years. Index clearly spiked after the Russian invasion of Ukraine and has since subsided almost back to baseline. This index is created from a tally of newspaper articles covering geopolitical tension, so it doesn't really measure actual risk so much as changes in the risk. Let's face it, newspaper articles will not sell well if they repeat the same risk every day. Still, investor behavior is more likely to track that newspaper coverage than actual risk. So this index is still quite useful to investors. But of course, investors should not be lulled into complacency just because the index is declining. Black swan risk still exists in Ukraine, Taiwan, and other regions of the world. We'd now like to move to part 3 of the slideshow, shifting from the macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'll be highlighting 5 industry discussion topics. First, how are megacaps faring after such a strong start to the year? Where are China stocks headed? Will COVID stocks lift with the flu season? Oil is bouncing, but for how long? Is the time right for bullet bond ETFs? In the first half of this year, the megacap tech stocks roared, partly on new advances in artificial intelligence and ChatGPT, and partly on reversion to the mean after being oversold in 2022. So going into the third quarter, many investors were wondering whether if that outperformance would continue or if it would take a rest. As you can see in the table here, the so-called Magnificent Seven did indeed take a rest. Not an underperformance, but rather a flattish performance in a flattish market. Seems the street has now raised expectations to a level where stocks are seeing limited reaction to positive earnings reports. The Magnificent Seven have played an outsized role in generating alpha or outperformance for most of the last decade. 2022 was the only year where the Magnificent Seven meaningfully underperformed the market, and 2023 so far seems to be making up for that outcome last year. The Magnificent Seven are likely to continue to dominate markets, owing at least in part to their enormous size and index weightings. But in addition, all 7 do retain deep moats, above average organic growth, and very high returns on invested capital. Has the China boom ended? After 30 years of annual GDP growth of nearly 10%, the Chinese economy has slowed to a snail's pace. The slowdown is especially noteworthy given near universal expectations of a 2023 economic rally after the COVID-0 lockdown was reversed in late 2022. Yet today we have GDP growth at a mere 3.2%, weak real estate markets, CPI deflation, declining business investment, and a stock market that is down 13%. What's happening? Is there any sign of recovery? The Chinese economy is indeed seeing signs of recovery, or green shoots, though you need to know where to look. And the recovery is happening underneath much negative media coverage of Taiwan geopolitical tensions and reshoring initiatives. The biggest piece of the puzzle revolves around excess inventory levels that are just now starting to decline. China did not give checks directly to its citizens like the US did during COVID, but rather ran their factories at full tilt to keep paychecks flowing to workers. So China, unlike the US, has a massive glut of unsold inventory that needs to be worked through before economic recovery can truly manifest. With excess inventory now trending lower, that has started to flow through to increases in household wealth and household consumption. The weak 3.2% growth in the second quarter is likely the nadir of economic growth. That said, the recovery will not be an immediate lift to the former 10% growth of a decade ago. There is still the headwind of excess debt levels at major property developers, a headwind that may last some years. Consensus is now that China will see a 4.8% GDP growth for 2023, a modest lift from the 3% in the 2022 COVID lockdown. In our last couple slideshows, we chatted about new biotechnology advances in diabetes and Alzheimer's that were big enough to move overall markets and even economies. Today, we would like to revisit COVID, partly because this is September, which is the beginning of flu season, and COVID vaccine makers are hopeful that there will be a role for them vaccinating against new COVID variants, not unlike the approach to the flu. Notably, the stocks of most COVID vaccine makers are under pressure, mainly due to declining earnings with the waning of the pandemic and the fear of so-called sunset risk. This is especially the case for the two pure play makers, Moderna and BioNTech. Others, like Pfizer and Johnson & Johnson, are more diversified and the stocks are holding up better. The hope for an annual COVID vaccine regimen lifted a couple of weeks ago on news of clinical efficacy of the new vaccine for the Eris variant. As you can see on the chart at the left, does this mean that we are in the early days of an annual COVID vaccine? We have seen this movie before. It started about 10 years ago when Gilead announced a cure for hepatitis C, a slow-acting but terminal virus that infected nearly 200 million people worldwide. The 2013 news was an enormous win for global public health, and Gilead earnings exploded sevenfold higher over the next 3 years. Like with the COVID vaccine companies in 2020 and 2021, Gilead stock roared in 2013, 2014, and part of 2015. But also like the COVID companies, once the disease was under control and earnings started to decline, the stock came under tremendous pressure as Wall Street ran away from the perceived sunset risk. Contrarians made the case that the viral reoccurrence or mutation or reinfection would drive future sales, but this scenario just never came to pass. Gilead eventually settled out at a lower price and has since been a simple trading vehicle and not really capitalizing on the enormous cash flows in 2013 through 2016. We suspect the Gilead story is a close parallel to the Moderna and BioNTech stories. There are a few differences, of course. Gilead was a larger established biotech with a sizable revenue base from its HIV business. Moderna and BioNTech are not diversified, they're pure plays. Also, Moderna and BioNTech have sold off more than Gilead, partly because of the fact that they're pure plays, but they are nearing cash values, which might make them more interesting as trading vehicles at this point. Bottom line, we are clearly skeptical about COVID becoming an annual vaccine, but we're about 2 years past the peak, the time at which Gilead started to lift on other news. Also, valuations of Moderna and BioNTech have dropped nearly 75% and are just over twice cash value, suggesting less downside from these levels. These stocks both seem likely to be entering that trading range phase now. Oil prices have been lifting in the last few months despite entering the seasonally weak period after the end of summer driving season. What's moving oil? Headlines are, as usual, pointing fingers at media villains like Russia and Saudi Arabia. And indeed, Saudi Arabia and Russia did announce that temporary production and export curtailment in July would be extended through the end of the year. Hurricane season is clearly a factor too, as multiple hurricanes have already swept through the oil-producing region of the Gulf of Mexico. And with inventories on the low side, these modest supply-demand perturbations are magnified. But is this move the beginning of a more persistent oil price inflation, or is it just a blip? We are inclined to believe that the lift in oil prices in the third quarter is just a blip. Usually a 20% plus move in global crude prices will be accompanied by some weakening of the global reserve currency, the US dollar, maybe on the order of about 5%. But the US dollar actually strengthened by about 5%, precisely the opposite direction. Further, the price of crude oil lifted, yet the price of refined gasoline barely budged. So the crack spread, the difference between the price of crude oil and refined gasoline, well, the crack spread dropped like a stone. The best explanation behind these factors is panicked refiners stocking up on crude oil either due to fear of OPEC or fear of hurricanes. And there appears to be a trade manifesting to either go short on crude oil or long on the crack spread. We mentioned back on slide 10 that bonds are increasingly compelling, and that we've been actually gradually increasing our exposure to bonds, but mainly through bullet bond ETFs. What are bullet bond ETFs? Well, these are exchange-traded funds that hold a diversified portfolio of bonds with similar maturity dates. This allows investors to build bond ladders with only a handful of ETF funds. The advertising jingle is actually well articulated, matures like a bond, trades like a stock, and diversifies like a fund. We do not want to be the advertisement for iShares or Invesco, but the right side of the slide lists the advantages as we see them: capital preservation, good liquidity, honesty, diversification, and cost effectiveness. There are many approaches to establishing a fixed income exposure. This table lists the four most common approaches for high net worth individuals. Bullet bond ETFs have been around for about a decade but have seen limited usage, at least in part due to the fact that rates were so close to zero for most of the last 10 years that, well, no one bothered. But higher rates have increased the attractiveness of all bond investments. As shown in the table, bullet bond ETFs appear to be in the sweet spot given excellent liquidity, low correlation with other asset classes, good capital preservation, and low expenses. We would like to conclude our slideshow with just one additional slide with a top-down and longer-term view. We've used this slide in prior slideshows, but we feel it's worth reminding investors that bear markets like 2022 frequently lead to bull markets. Post-trough returns can be significant, with 1, 3, and 5-year return averages of 53%, 87%, and 139% respectively. The stock market has many ups and downs, but patience is a virtue. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.